Welcome to Talking Point. I'm Tamanna Inamdar, and we're speaking today with Dr. Taimur Baig. He is MD and Chief Economist at DBS. Dr. Baig, thank you so much for speaking with us. Absolute pleasure to be
Pleasure is
talking
mine.
with you, especially at a time when so much is going on in the global economy. We're speaking on a day when crude is, again, reaching scary levels. So let's begin with that. Let's begin with crude. There is a prediction of crude at 100. While we're speaking, it's hovering around 97, 98, Brent, that is. Do you see crude pinching and implications for the Indian economy?
Okay. Yes, given the supply-demand makeup around the world in terms of refining capacity, in terms of storage, looks like we're at a bullish part of the cycle as far as oil is concerned. But I would make two important points. One is we shouldn't worry that much. And second is the cycle itself may well be short-lived. So why we shouldn't worry about it? Well, we have lived with $100, $110, $140 oil in the past, and not in recent past, going all the way back to 2008. So the world in the last 15 years has seen $40 oil, $100 oil, $140 oil. That has not been the spoiler, if you will, for the global economic cycle. There are many other things going on. Of course, energy-related inflation is a concern. Of course, that leads to some pressure on the current account and the currency. But that is not going to be the maker or the breaker of the economic cycle in India or globally, in my view. In real terms, oil today is, even at $100, substantially lower than anything we saw during the previous bull runs of oil in the end of 2008, as well, 2009, and as well as in recent years. So first and foremost, I think it's important to understand that we have seen this before. We've taken this in our strides. We have the absorptive capacity to deal with $100 oil. It's okay. Now, even if that is still an uncomfortable dynamic for economic observers and market participants, let's also keep in mind that in the last year and a half, global energy suppliers have shown pretty heroic capability of ramping up production. A year ago at this time, when there was peak panic around Ukraine, a lot of people said that the US production capacity was sort of inelastic. They were going to take a very long time to go back to pre-COVID levels of production. Well, it turns out high oil prices have an amazing impact on galvanizing supply. And that's what we saw in the US. US ramped up supply by 10, 15%, and they're on the verge of going back to pre-COVID level of production. Same with gas. We felt that, once the Russian gas toward Europe would face some friction, that would cause huge amount of energy uncertainty. Looks like between US gas producers and Qatari gas producers, Europe managed to secure substantial supply. So I think that on the supply side, there is still capacity, temporary inventory, and refining dislocation notwithstanding. Now, finally, let's talk about the demand side. We look at the US, looks pretty good, but that's where the good story more or less ends. We look at Europe, we look at China, we look at the export-oriented countries of Asia. Demand is clearly not that great. So demand not very good, supply-related issues kind of temporary. I wouldn't worry too much about oil going toward 100. It will not be long-lived in my view.
Is a larger worry the stance coming in from the Fed last week and the impact it will have perhaps? And previous note or a recent note from DBS does talk about how Asian central bankers will respond. We have a MPC meet in Mumbai next week. Do you expect that hawkish tone to filter through? Because we've been waiting for the RBI to perhaps start cuts early next year. Has that timeline sort of gotten pushed forward?
I'm afraid so. And it's not just the Fed. We'll talk about the Fed in a second, but also I think there are domestic factors, especially with respect to food inflation, that is turning out to be a source of headache as far as the RBI is concerned. I don't think the RBI is going to be very concerned if the rate cut cycle gets delayed by a little bit. I think overall the economy is not dying for monetary easing, or it's not like liquidity is so tight that the market, the business cycle requires substantial easing. It's nothing like that. So I think the RBI is in a good position where they can convey some degree of inflation fighting credential and perhaps signal that it will have to take a closer look at what's happening with overall price dynamic before entertaining easing measures at some point next year. So I think that unfortunately is a given, given the domestic drivers. Now, the external drivers, whether it is oil or the Fed, the Fed is a very big source of headache. I think the Fed tightening over the last year or so, we haven't felt it entirely yet. It's about to come. In terms of real interest rates being high, in terms of dollar liquidity becoming tighter progressively, in terms of emerging market currencies, including the rupee feeling pressure of the mighty dollar sort of, pulling itself up because of the high interest rate differential between the US and the rest of the world. So I think that the Fed tightening and the fact that they are very keen to give this signal that, the rates will be high for a prolonged period of time, that could be a source of destabilization for global markets, particularly the financial system. We've seen and prelude to this already in the early part of this year when a couple of regional banks in the US faced substantial duration risk and saw liquidation risk, and that became a source of concern as far as contagion is concerned. Didn't spread too much. The Fed banks came in and intervened quite vigorously. But is that it? Or could there be more accidents lurking in the corner for companies, lenders, or creditors who have big duration mismatch and is not really prepared to deal with such high interest rates? So that certainly is my worry. I'm much more worried about them than oil.
Okay, so Fed is a bigger headache than oil at this point. Let's just focus for a second on the China piece of the puzzle. And bad news sort of piling up there. Growth estimates for China were already lowered. Does the Evergrande implosion make things worse? News coming in that the stock has been suspended, the founder is under some sort of police control. Is that real estate piece going to unravel at an even faster pace?
So none of these news items help, no question about it. There's no way to sugarcoat any of these developments. I do think that the chance of an outright crisis stemming from housing to banks to households, the way we saw it happen in 2008, 2009 in the US, I think that's pretty unlikely in China. I think the authorities have far more levers in place to intervene than the US had. For example, a Lehman moment, in my view, is sort of unthinkable as far as China is concerned. They've seen how those things unravel, and they will not let that happen. Similarly, as far as banks are concerned, I don't think a bank run, or for that matter, the RMB facing huge amount of shorting by Chinese individuals, I think those things are unlikely. The typical things that happen during a financial crisis. People take the money out of banks, people try to convert to a foreign currency. Those things I think are unlikely in the context of China. There is significant greater degree of control as well as confidence in the authorities' ability to backstop the system. So I don't think people will panic like that. Having said all that, huge burden of debt, dysfunctionality among the various players in the property system, whether it's the local government financing vehicles or the property developers or the banks that are in the middle of all these, everybody has to deal with some degree of reckoning, some haircut, some loss recognition, some equity write-down. I think is very, very likely. And how can that help? Eventually, things will be cleansed, the system will move on, but the transition to that period would be rather painful. And this is true for every country that has dealt with a housing crisis in modern financial history. China cannot be any exception.
Yeah, but the interesting take is that you're saying this is not China's Lehman moment. They have enough at their disposal and speed to rein things in.
So if you just think about the Lehman moment, that the money markets were unwilling to fund the day-to-day operations of Lehman Brothers, I think something like that is very unlikely in the case of China, because if indeed there is a liquidity call, let's say, on a bank or a non-bank financial company, I think the authorities have enough strength and lever available to make sure that the liquidity issue does not morph into a solvency issue. And also, it was a decision made by US regulators to let Lehman go. They could have come up with ways to sell it. They decided not to. I don't think that is likely in the case of China. Secondly is that, the deep layers of securitization where, CDOs built upon CDO squares and so on. I had some worries about that in the context of China 5 years ago, when there are a lot of shadow banks that were issuing all sorts of structured products. That risk is behind us. Those products had 2-3 year tenors. They're all sort of, matured or taken care of. So again, so that sort of parallel, I will be, I'll struggle to draw between the Lehman moment and China right now.
All right, let's turn our attention to India and what's happening here. After I think, positively surprising 7.8% GDP growth in Q1, expectations have been moving up for the financial year. Your own expectations are between 6 and 5.8. Is that a more conservative view? What are the sort of headwinds you see going forward? Is consumption, slower capex because of an election cycle, some of those moving parts?
So Tamanna, we run what we call a real-time nowcasting of India. So even before the quarterly data comes out, we take all the monthly data and we put into our model to get a very good sense of, what would be the ultimate GDP outcome long before GDP comes out. So the number that you just cited is based on the nowcasting exercise. It turns out to have a pretty decent track record in recent quarters in terms of calling what the number would be for India for that quarter. Now, why are we seeing a somewhat lower number now for the second quarter of the financial year than the first quarter? Not necessarily that there's major sequential slowdown. There's a bit of a base effect in place. And also in terms of capex, in terms of sort of the net exports contribution to growth, we're seeing some degree of softening. But I would say these are marginal issues. It's not something that is making us worried about India or compelling us to start sort of taking a double take in our overall financial year forecast. So I think it's a year-on-year slowdown as opposed to a major substantive sequential slowdown.
All right, but let's just focus on India and the growth outlook a little more. Still pegged to be one of the fastest growing economies in the world, this year at least. What is the picture emerging like for you, and what are the challenges you see down the road?
I think the challenges are obvious. If you have high interest rates in the US, if you have some degree of stubborn domestic inflation, these things get in the way of orderly management of the macroeconomic environment, and that can lead to some dissipation of animal spirits, some dissipation of momentum in the capital markets, and so on. So that, I think, is consensus, unsurprising as far as risks associated with India are concerned. I'm not going to put the election as a major source of risk. We have run even studies looking at elections in the last 20, 25 years in India. There have been times when the government was in a precarious state. There have been times when the government was in a very commanding state. In any of those cases, we don't see what we call a political business cycle in the context of India, meaning you don't see major slippage leading into the election. You don't see major slippage after the election because some things were kept under rugs. It doesn't quite happen that way. And one of the reasons for that is that public sector expenditure as a share of GDP is actually not that large, especially you compare to OECD countries or even a country like Brazil. India's government is relatively small. So even if there is a certain amount of pre-election, post-election volatility, it doesn't affect the entire multi-trillion GDP that meaningfully. It might affect some localities, some municipalities where there is some big election and around that some spending is done, but system-wide, we don't see major impact. In the past, we used to see some macroeconomic impact on the external variables, the rupee, FII flows. I don't think in this cycle, again, we don't need to worry that much about it. And most importantly, and I think this is critical because this sort of varnishes India's democratic credentials tremendously, which is even the parts of the business cycle where we have seen substantial swings in seats or substantial tenuousness in terms of leadership, we haven't seen any major shift in policy. And I think that's the critical one, both for domestic and foreign investors, that of course, we will spend a lot of time between now and the election, who's going to win and how many seats they're going to get, what does it mean? But the fact of the matter is, as far as the markets are concerned, as far as the economy is concerned, it doesn't mean that the outcome would then start affecting policy. I don't see that happening, and that I think should be a source of assurance for the markets.
Absolutely. And you see that spilling over to all segments of the markets, equity, fixed income, and of course the economy as you're speaking?
Well, I think the domestic investors' interest in the financial markets, we're seeing a sea change. So think about the last couple of years when foreign investors have actually been rather shy about investing in India, during which time we've seen a surge in domestic flows going into mutual funds, going into domestic bonds, and so on. So this tells me something healthy occurring, that you don't want too much reliance on hot flows to maintain your day-to-day expenditure and day-to-day bills. If domestic savings is now percolating from sitting idly in banks to more productive parts of the economy, then even if we are going to see in 2024, let's say around the Fed hike cycle, some degree of global volatility, it doesn't necessarily spell doom for Indian markets. So that's the good takeaway, that domestic investor sentiment is strong. It has withstood the last couple of years of global market volatility. So we would need much more than $100 oil to ruin that party.
Let me come to the big sort of wow moment as far as the Indian economy is concerned, and at least was celebrated that way, is the inclusion of Indian government bonds in the JP Morgan index. Do you see that having a substantial impact on flows?
I'm reminded of that quote from Spider-Man: with great power comes great responsibility. So yes, great to be part of a big global index. That by definition brings in some flows, but that also brings in additional scrutiny. So the way the fiscal accounting is done, the way fiscal reporting is done would be under far greater scrutiny now by global investors than ever before. So flows, yes. Scrutiny, yes. So you take your pick which one you want. I think it's good to actually have greater scrutiny and greater market discipline on the Indian government's financing, issuance, and so on. I think it is good to have investors globally or domestically coming to the Ministry of Finance, to the debt management people, to get a sense of the duration of the debt, the issuance calendar, and then trade around that. I think that's a very good disciplining mechanism. So yeah, scrutiny will come. There won't be any free lunch, but I think it's a good thing for the long term.
Yeah, and we should welcome it. Absolutely, we should, because like you said, with great power comes greater responsibility. Thank you so much, Dr. Baig. Always a pleasure to speaspeak with you.
Pleasure is mine. Thank you.
Thank you.